Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets for May 2020. What a salient reminder that markets are made up of many parts, both fundamentals, which we know are in dire shape as a result of COVID-19, technical factors, and certainly liquidity. And liquidity has been a huge part of the reason that markets have done very, very well over the course of May in terms of risk market performance. We know we've had huge liquidity injections as a result of COVID-19, rate cuts and stimulus, but it really has been an incredible rally, an unexpected rally in many respects from those liquidity provided levels. But we still feel that the rubber of the road must meet the fundamental situation later on. And so we just caution investors to think through, this has been an incredibly powerful momentum based trade, but that momentum can work in both directions, and we certainly saw that in March of this year. So do be careful and think through your asset allocations very carefully. Interestingly, I think we had a similar period in the 2008 market year where we had a sell-off in risk assets early on, followed by a rally that lasted around 3 months before ultimately another sell-off. It's worth considering that period because in 2008, the US economy was 96% of the 2007 economy, and that generated the largest recession we've seen since the Depression of the 1930s. It's very likely that 2020 is far worse than a negative 4% of 2019. In fact, the Fed Now publication, the GDP Now from the Central Bank or the Federal Reserve Bank of Atlanta, predicts that second quarter GDP could be more than negative 50%. Now, clearly, on a rate of change basis, as the economies reopen, we're going to see some staggeringly large growth numbers coming off such depressed numbers. But in totality, it's very unlikely that the economy can regain anything like of its 2019 levels. We still have 42 million Americans that are newly unemployed, and reports in the media suggesting 1 in 4 Americans is skipping on meals or requiring food collections in order to feed themselves through the COVID-19 epidemic. So we still feel that underneath what has been an amazing recovery in terms of coming off the lows from the COVID-induced sell-off, there are some serious issues that we need to deal with. It's interesting to us, I guess, that how quickly the bar has been moved on many of these social or financial programs with very, very little real debate. The universal basic income crowd and the modern monetary theory crowd were pretty widely denied under capitalist systems ahead of this time. But in many respects, both of those programs are fully operational now, and they've been greenlit by folks that are unelected by the people who've committed trillions of dollars to these programs. I think it's amazing how quickly this is all moving. We certainly know from prior episodes when we've had things like quantitative easing, we never got out of those programs. And so will these programs stick around? Will they change the fabric of society and the economic construct going forward? They're all interesting things to think about. Clearly at the moment, we're seeing substantial violence around the world as a result of a catalyst which has been race-based in the United States. But we think that there's more to this, and we will continue to see this with vast swathes of people on unemployment. Clearly, governments have used this opportunity to bridge the cash flow of the situation, which is delaying some of the economic consequence, and that's been a good thing. But we know here domestically the government is very committed to removing and winding down things like JobKeeper and JobSeeker. So maybe the pain is in front of us still when these programs of really disaster relief are wound down and the realities of the day might be more evident than in the market kind of view. Throughout the month, I think it's interesting to note that despite all of the optimism of risk markets, bond markets really aren't buying into this in any way, shape or form. It's not to say bond yields aren't moving a little bit, but broadly over the month of May, they didn't move much at all, and the returns across our funds suggest that, with slightly positive returns in our domestic fund and a slight drawdown in our global funds. Clearly, the bond markets have long memories, and I think they well realise that we're likely to see some volatility through this series, and the momentum in an algorithmic-based world is incredibly powerful and can be very difficult to stand in front of. But when it does roll over, I think then it does look more interesting, and we would expect that this episode must meet a crescendo at some stage where that reality does kick back in. But for now, we're trying to open up economies. We're hoping that the virus doesn't come with us and we don't have large second wave outbreaks. And hopefully we can get back towards the most optimised economy we can have in this frame, in this state of social distancing. We know the borders are likely to be closed. Travel and tourism is going to be deeply affected. In Australia, our export of education and those types of things will be deeply affected. But thankfully, in Australia, we've done a great job on a health front, and hopefully we can get closest to our optimised shape as quickly as possible. Thank you very much.